3 years ago, a trader named Dave woke up to a margin call notification and an account balance that had dropped by $70 overnight. The strange part is the price had only moved 11 pips against him. 11. That number should not have been enough to wipe out that much of his account. It was enough, because Dave never actually learned what a pip was worth, what he was paying just to open the trade, or how much of his own money was standing behind that position. Today we fix that. Base currency, quote, currency, pip, spread, margin, leverage. The 5 words that decide whether a small move against you is a shrug or a wipeout. Dave's trade was on Eurodollar, one of the majors. Majors are pairs built around the US dollar and the handful of currencies behind the largest, most stable economies. The euro, the yen, the pound, the Swiss franc. They trade in enormous volume, so entering and exiting is cheap and instant. Miners, sometimes called crosses, pair 2 of those major currencies against each other without the dollar in the middle. Still liquid, still fairly stable. Exotics bring in currencies from smaller or less stable economies, Turkish lira, South African rand, and the volume just is not there. Less volume means wider gaps between buying and selling price, and that gap is money leaving your pocket before the trade even starts. Dave got lucky picking a major. But which side of Eurodollar was actually being measured against the other? That's where most beginners already get it backwards. In Eurodollar, euro is listed first. That makes it the base currency, the thing being measured. Dollar is listed second, the quote currency, the ruler you're measuring it with. 1 Eurodollar quote just tells you how many US dollars 1 euro is worth right now. Here's the part that trips people up. Your profit or loss doesn't show up in euros. It shows up in the quote currency, dollars for Dave. So when the price ticks up, he's not gaining euros, he's gaining dollars, measured against how much the euro moved. Simple enough. But how do you even measure how much it moved? Saying the price went from one number to another doesn't mean anything until you can count the actual distance, and Forex has its own ruler for that. That ruler is called a pip, the smallest standard unit of price movement in most currency pairs, sitting at the 4th decimal place. Eurodollar at 1.1050, moving to 1.1085, has moved 35 pips. Try this yourself. Pause the video right now, and if Eurodollar goes from 1.1200 to 1.1170, how many pips did it drop? Got a number? It's 30. Every pip on a standard lot is worth about $10, which is exactly why Dave's 11 pip loss stung more than he expected once leverage got involved, and we'll get to that. But some brokers quote 1 digit further than this. What is that extra digit even measuring? That extra digit is the pipette, a fraction of a pip, usually 1/10, that some brokers add for tighter, more precise pricing. So instead of 1.1050, you might see 1.10503. That last 3 is the pipette. It doesn't change how you count pips for profit and loss, but it does mean the price you're quoted is sharper. Here's the thing though, a price is never just one number in this market. Every single quote you see is actually 2 numbers stitched together, one for buying and one for selling. And the space between those 2 numbers is where your actual cost lives. The bid is the price the market will pay to buy the base currency from you. That's the price you get when you sell. The ask or offer is the price the market wants to sell the base currency to you. That's the price you pay when you buy. The gap between them is the bid-ask spread, and brokers usually only show you the last couple of digits changing, since the front of the number rarely moves. The standard way it's written is base/quote, bid over ask, Eurodollar, 1.1050 over 1.1053. That gap isn't decoration, it's the toll booth on every single trade you take. And here's a rule that matters everywhere in this market. Context, the session, the pair, how liquid it is right now, decides how expensive that gap really is, far more than the raw number ever will. Here's where it gets real. Say Dave spots price pulling back into a support level that already held twice before. That's his entry trigger. And where it happens matters more than what the candle looks like, always. He buys. His stop goes a few pips below that support, with a little wiggle room so normal noise doesn't shake him out early. His target sits at twice that risk distance, a 2-to-1 reward. Clean plan. Except the moment he clicks buy, he's already down the size of the spread, paid once going in and again going out. That's his transaction cost, the true price of a round-trip trade. And no matter how good the setup looked, it can still fail. The stop is not a suggestion. The stop is the only thing standing between a small loss and the kind of morning Dave had. That's the cost on a major pair. But the part that actually saves your account is still coming. What happens on a pair that doesn't even touch the dollar? Remember, context beats the pattern. The stop is what saves you, and nothing replaces practice on a live chart.